Okay, folks, let's talk about Sarbanes-Oxley. If you remember, when I talked about what I call the fundamental problem in accounting, at least from a moral perspective, it is that management employs the accountants who serve as auditors, especially internal and external auditors, for the sake of financing and obtaining credit or equity financing from the financiers. And the fundamental problem is that management pays the auditors, because that influences or shapes the thinking of the auditors. Okay, now much of what we're going to be looking at in the subsequent presentation here today is a very detailed explanation of how the government, through the Sarbanes-Oxley law, has attempted to separate these two groups as much as possible from each other. Separating management from auditors, giving auditors some independence, or as much as possible some sort of an ability to see things impartially. And I'll point out the ways in which this has taken place through the law in the course of the presentation. Okay, Sarbanes-Oxley is a very expensive piece of legislation from the perspective of particular businesses. I just thought I'd mention that at the outset. Here, for instance, is a quick breakdown of the added expenses that are a result of the increased regulatory requirements. This is a breakdown for a typical Fortune 500 company with $3 billion in sales, global operations, and in-house internal audit function, in-house legal counsel, and significant disclosure requirements. As you can see from these numbers, the initial fees and the annual fees, this is a very expensive proposition. And a large number of companies have actually gone private as a result because government regulations are very expensive. Government regulations may be expensive, but they also serve a purpose. They help ensure that the enterprise is functioning as required and that the financial statements are trustworthy. Okay, just as an example, here at HBU, a substantial percentage of your tuition dollars actually goes to meet regulatory requirements. Okay, so does anyone want to take a guess as to what I don't know what the particular number here is at HBU, but what is the average number, the average percentage of student tuition that goes to meet accreditation requirements for the school? Frankly? It's less than that, 30% is a little bit high. It's about 11. About 11% of your tuition dollars go to meet accreditation requirements. So that's, a substantial added expense. Tuition would be 11% cheaper, but HB wouldn't be accredited if we were to go that route. Okay, Sarbanes-Oxley was brought about by the perfect storm of 2001. That included especially the Enron scandal. Enron was the largest corporate scandal in American history, and it was the scandal that touched off the Sarbanes-Oxley law. It was so bad, so beyond the pale, the entire operation was found to be fraudulent, that the government passed the largest piece of legislation in its history regulating the accounting profession and more generally the financial profession. It was also brought about by a downturn in the economy and massive business failures. Okay, what does Sarbanes-Oxley do? I'm going to give you guys a couple or 3 slide overview here of what Sarbanes-Oxley does. One thing that it does is it ends the accounting profession's era of self-regulation. Prior to Sarbanes-Oxley, the accounting profession more or less regulated itself. So that included internal review boards, private mechanisms of regulation. Okay, can you get off your phone, please?
I'm taking notes on.
Oh, you're taking notes. Okay.
Because I forgot my pen.
Right, I understand. Okay. All right. That's fine. That's fine for today. In the future, yeah. Bring your notes. That'd be cool. Thank you. Thank you for clarifying that. Okay. So the accounting profession prior to Sarbanes-Oxley was private in its regulatory efforts. After that, the government, through Sarbanes-Oxley, gave itself sweeping powers to regulate accountants, corporate management, boards of directors, and attorneys. Okay, in public companies, it's typical for the leadership structure in public companies to be divided into 2. Okay, the C-suite level executives, this is something I've talked about in class before. The CEO, the CFO, the CTO, the CIO, people like that, and also at the same time a board of directors. And the idea is that the board of directors serves as an independent check on the powers of the CEO and his or her team. Okay, so the C-suite level executives are typically the day-to-day leadership, and the board of directors is a more distant but still important leadership body. Both of these shape policies. The board of directors does things like they vote on compensation for management. They decide how much power different executive positions will be given, etc. And the idea there is to have in this dual structure a kind of an independent check on the power of the C-suite level executives. Sarbanes-Oxley is intended to apply both to the C-suite level executives and to the board of directors, so as to prevent the abuses that happened at Enron, where the executives actually controlled the board of directors and were able to influence the board of directors to engage in fraudulent operations. And Sarbanes-Oxley attempts to separate these two from each other and also to apply strict regulatory standards to both parties. Okay, who does it apply to? Well, publicly held companies, also the auditors of public companies, and all CPAs who are auditing or working for publicly traded companies. So a number of different parties. As mentioned, it was touched off by large corporate scandals, especially the Enron scandal, although also to some extent the Worldcom scandal. And as mentioned, the Act had a far-reaching impact on corporate governance and conduct, financial reporting, and the public accounting profession. One other final thing, just to summarize, that the Act was intended to accomplish was to improve investor confidence in financial reporting. After the Enron scandal, investor confidence in financial reporting plummeted, as it should have done, because Enron was faking its financial reports. And the idea here is to increase the oversight of corporate governance so as to improve investor confidence, and also, as mentioned, reducing fraudulent practices and accounting inconsistencies. Couple last preliminary comments before we get into the nuts and bolts of Sarbanes-Oxley. The law applies to companies that are defined as issuers. Okay, so there are about 15,000 such public companies. That means companies with more than $1 million in assets and at least 500 shareholders. Often you'll see companies that don't want to have to pay all the expensive fees that are required to comply with Sarbanes-Oxley, and so they'll cap their shareholder numbers at 499, so as to avoid government regulation. Okay, companies that have registered securities with the SEC and are required to file periodic reports. Okay, if you remember, I think we've mentioned this in class before, all issuers are required to file reports like 10Qs and 10Ks. A 10Q is a quarterly report, a 10K is an annual report. There are also another report that will be mentioned in this presentation is an 8K. That's a special purpose report, like if some special business event has happened that is material to the public's knowledge about the company is required to file a report with the SEC so as to be in compliance with Sarbanes-Oxley. Okay, Sarbanes-Oxley, this is, by the way, sometimes abbreviated SOX. Sarbanes-Oxley creates the Public Company Accounting Oversight Board, or the PCAOB, which is funded by accounting firms and registrants. We're going to talk in detail about that momentarily. It also revises corporate governance standards, adds new disclosure requirements, and creates new federal crimes related to fraud. Finally, one last thing that we will be touching on in this presentation is an increase in criminal penalties for violations of securities laws. Prior to Sarbanes-Oxley, white-collar crime was punished very lightly in this country, and Sarbanes-Oxley increased the penalties for such crimes. It especially impacts senior executives, boards of directors, and board committees, although it also impacts other parties such as outside auditors. Okay, let's get into the nuts and bolts of the law. Here's part one. Okay, we are in part one of Sarbanes-Oxley. So the entire law is about, I believe, about 35,000 pages long. Okay, we're not going to be covering that. We will be covering the most important parts. Okay, in a relatively short presentation. I'll try to make it as painless as possible. But it is that long primarily because corporate executives have proven themselves to be so slippery. Okay, they are slippery and they seek to find loopholes, and the law needs to be written in a way that prevents those loopholes from being large enough for executives to drive through them. Okay, let's talk first of all about the PCAOB. This is an important aspect of Part 1 of Sarbanes-Oxley. This is the board, remember, that takes regulation of the accounting profession outside of the hands of private regulators, places it in the hands of the government, and the PCAOB regularly inspects or regulates the operations of accounting firms that do audits for public firms. Okay, it has 5 members, and it is responsible for registering all auditors of public companies, for inspecting and disciplining those auditors, so it punishes them where necessary. It also establishes and adopts auditing, quality control, ethics, independence, and other standards relating to the preparation of audit reports for issuers. In other words, it sets the standards for expectations for quality control, independence, and auditing mechanisms. Okay, the PCAOB regularly inspects auditors. And this part of Sarbanes-Oxley was a result mainly of the Arthur Andersen role in the Enron scandal. Okay, if you recall, Arthur Andersen, this very venerable, respected accounting firm at the time, they had a conflict of interest, and I talked about that when we did this. Their conflict of interest was they were acting both as an auditing firm for Enron, and they were also acting as a consulting firm, okay, which meant they were playing the referee role and the advocate role simultaneously. Okay, and so the PCAOB really is supposed to clamp down on that kind of behavior and prevent accounting firms from being too chummy with management in a way that makes them see their own interests as fully aligned with the interests of management. In the interest of this, the PCAOB conducts regular board inspections and reports regarding auditors. Sarbanes-Oxley requires the PCAOB to inspect at least every 3 years all auditors of public companies. The inspection report becomes public information after an appeal period. Okay, so that means that all auditors of public companies have to turn over their books and demonstrate that they are complying with various federal regulations. Okay, the PCAOB is also supposed to investigate and discipline any violations of Sarbanes-Oxley, any violations of board rules, securities laws, and professional standards. Okay, and finally, disciplinary sanctions by the PCAOB have to be reported to appropriate state regulatory authorities. The PCAOB is not a really big, bad federal board. I'd say in comparison to the DOJ they have the power to jail you forever. The SEC, the CFTC, the PCAOB, these kinds of other regulatory boards are mild in comparison to the DOJ. Okay, the PCAOB, they can strip you of your accounting licensing, they can put you in the penalty box, but it's really a milder regulatory board than something like the Department of Justice. Okay, the PCAOB establishes auditing standards that require work paper retention for a certain period of time. Okay, just like you are at least suggested, but it is suggested by the IRS that you retain your yearly tax records for 3 years. So also, in the same way, auditors need to retain their work paper retention for 5 and 7 years, depending on the firm. CPA firms also have to utilize a second partner review and approval of auditing reports. There has to be regular testing of companies' internal controls, including the reporting of test results. Okay, some of the effects of the PCAOB and its regulations on CPA firms include the following. All auditors of more than 100 issuers are required to submit to an annual quality review or inspection. Okay, so basically the larger auditing firms have to submit to more frequent reviews and inspections from the government, is what this is saying. Other issuer auditors, those who are not as large, are supposed to be inspected at least every 3 years. And auditors must report to audit committees, not to management. That's an attempt to creates some distance between these groups. Management appoints an auditing committee. The auditors report to the committee and not directly to management, with the idea that the auditing committee will be somewhat independent of management's interests. Okay, the last part of part 1 of Sarbanes-Oxley. All accountants must obtain audit committee pre-approval of all issuer services, including auditing and tax services. Okay, that means that they have to go to, as I mentioned, the audit committees that are set up by management to get pre-approval for the services that they're providing, so that they can't go freeloading and provide other kinds of services. Okay, the reporting that is required by accounting firms to the audit committees include things like key accounting policies and practices, the existence of alternative GAAP, if there is such a thing. Let me pause there for just a minute. You guys all know what GAAP is?
Generally accepted accounting principles.
That's correct. Generally accepted accounting principles. It's a standardized way of conducting accounting in the United States. Okay, and all the developed countries around the world have versions of GAAP. And it includes things like you have to count the stock options a particular way, you have to count the assets and liabilities a particular way. And often it's something that actually companies don't like because GAAP requires it. Companies like to, especially if they're public companies and they rely upon public financing, they like to manipulate their reports so as to appear in the best light to the public. Okay, and that means they'll move things around, they'll shuffle things around on their balance sheet or their cash flow statement or something like that, their income statement, so as to, present the company in the best possible light. And GAAP is kind of a speed limit on that. It prevents them from being able to do as much of the shuffling as they'd like to do. And so often what you'll see when companies are trying to pitch a particular narrative or engaging in shady behavior, what they'll do is they'll present their GAAP earnings, and then they'll also simultaneously with that present a non-GAAP version of it. And they'll say, well, here's our GAAP, but here's our non-GAAP reports. And, look over here. It's sort of like, you wave the red flag for the bull, right? When you see that and you are an investor, run away. Run away from companies that engage in such behaviors. Best is to invest in companies, of course, that are abiding by GAAP and not trying to push the line. Okay, required reporting to audit committees also must include any disagreements between management and the auditor. And finally, the engagement and concurring partners have to be rotated every 5 years. In other words, these groups can't stick together for too long. They can't come to get the family feel that comes with being an auditor for a particular company for too long a period of time. Okay, that's part 1. Questions or comments about part 1 or about anything that we've talked about so far? Okay, I shall pass the Oreos around again. Let's start in with part 2. Thank you for your patience. I appreciate it. I'm going to try to make this as painless as possible. Part 2 is a part of Sarbanes-Oxley that deals with requirements affecting senior executives and individual directors. Remember the 2 parts leadership structure that most public corporations have. No one wants an Oreo? Okay. I guess everyone's just had breakfast, right? So, and oh, you already ate 2. Okay. So okay, I'm a pusher, aren't I? All right, well, I will leave them up here in case anyone wants to step out and grab one. Okay, CEOs and CFOs after Sarbanes-Oxley now have to certify all financial statements to assure accuracy, completeness, and timeliness. So a bunch of the Enron execs hid behind the corporate shield and avoided personal liability because they said, well, I never personally certified these financial statements, suggesting, I didn't know what was going on. And a bunch of them tried this legal defense. It worked for some, didn't for others. The Sarbanes-Oxley law now says that all leadership, CEOs, CFOs, have to personally certify financial statements. This places them under personal liability if those financial statements are fraudulent. Okay, increasing the bar, as it were, for companies, increasing the the incentive package for executives to ensure internal controls over the truthfulness of their financial reporting and ensuring that that financial reporting is indeed accurate. Okay, companies also have to establish and assess disclosure controls and procedures for their periodic reports. And moreover, another requirement affecting senior leadership is mandatory adoption of a code of ethics for all senior financial officers. In other words, they all have to sign a code of ethics now. Okay, moreover, there are penalties for willfully misrepresenting and intentionally signing off on fraudulent 10Ks and 10Qs. So Sarbanes-Oxley increases the penalties for this kind of behavior. Executives are now required by the law to communicate to auditors and to audit committees the nature of any deficiencies, especially significant deficiencies in the design or operation of their internal controls. They also have to communicate any fraud involving management or other employees with controlling roles. Okay, in other words, if fraud is taking place, the law requires them to report that fraud is taking place. Okay, you'd think this would be a no-brainer, but actually enterprising lawyers in the courtroom have made the case that, well, my client didn't know that he had to report that fraud was taking place because the law doesn't say he has to report that fraud is taking place, right? Okay, so there's that, right? So Sarbanes-Oxley has to say explicitly, if fraud is taking place, you must report that fraud is taking place. Okay. Section 302 certification is especially important in Part 2. Under Section 302, the CEO and CFO must do the following. They need to state that the company's financial statements, that is the 10Q and 10K, fairly represent the company's financial position. In other words, they have to, put their own persons on the line and accept personal liability for any fraudulent behaviors. They also have to state their responsibility for establishing and maintaining effective disclosure controls and procedures. Okay, a little more on Section 302, this key, crucial section of Sarbanes-Oxley. The CEO and CFO have to certify both quarterly and annually that the SEC report does not contain any untrue statements or omit any material facts necessary to make the statements made not misleading. Again, they have to certify that this is not a misleading financial report. Financial statements also have to fairly present in all material respects the company's financial position, the results of its operations, and cash flows. Any deficiencies and material weaknesses in internal control have to have been disclosed to audit committees and to auditors, as well as any fraud involving anyone with a significant role. Again, placing management in a position of personal liability should they fail to exercise sufficient internal control over the operations of their companies. Okay, there are some other additional disclosures that are now required. Okay, for instance, all off-balance sheet transactions have to be disclosed, all contractual commitments, and all contingent liabilities. If you remember when I was talking about Enron, I mentioned how there was Enron, and then they made up about 65 special purpose entities where they offloaded debt onto these other entities. So it looked to the public as though Enron was one thing, and then they were hiding all this debt elsewhere. Okay, off-balance sheet transactions now have to be disclosed. There has to be pro forma information quantitative reconciliation. All other material and non-public information about annual or quarterly fiscal periods have to be disclosed on 8Ks. I mentioned 8Ks a minute ago. Those are the special reports that have to be filed if and when somebody's doing something out of the ordinary. So if Zuckerberg wants to dump a bunch of shares, he has to file an 8K. Okay, Section 404 certification is also important. Okay, under Section 404, the CEO and CFO must state their responsibility for establishing and maintaining an adequate internal control structure over the company's financial reporting. Okay, they have to also assert the effectiveness of the company's internal control structure vis-a-vis financial reporting. Government tried to set up the law so that management would be incentivized to exercise internal control over the financial reporting of their own companies, knowing that often different parts of companies might be fraudulent, but the company as a whole might not be, and management might actually be unaware of some fraud that's taking place in certain parts of the companies. Okay, the government tried to set up the law so that management would be incentivized to police their own and to try to, sniff it out where the corruption is occurring within their own companies, so that management would be on the side of the public, and so that the public, investing public's confidence in the process could be reestablished. Okay, Sarbanes-Oxley makes it unlawful for officers or directors to fraudulently influence auditors for the purpose of creating misstated financial statements. Okay, so now you can't call up your auditor and threaten them and say, well, if you don't see things my way and, set up the income statement the way I want you to set it up, or, for an external auditor, if you don't give me a clean bill of health for my financial statements, then I'm going to ensure that you never audit anyone again because I'm going to make it impossible for you to get business. They can't call them up and say that anymore because you can't fraudulently influence auditors now. Okay, couple of other important requirements affecting senior executives and directors. All officers, directors, and other insiders are now prohibited from purchasing or selling company stock during blackout periods. This is usually like a 2-week period in and around quarterly reports. It might be a 2-week period in and around other important things like the announcement of a drug company's drug trials. They can't sell their stock, in the 2 or 3 days prior to that announcement. At least officially they're not supposed to. Also, Sarbanes-Oxley bans loans to executive officers and directors. You guys remember that Kozlowski dude we were reading about who got a bunch of interest-free loans given to himself by his company? He sort of helped himself to the company till, and then eventually these loans turned into grants so he could buy himself a waterfront mansion and all sorts of special yachts and paintings and other things. Okay, they can't do that anymore. They can't loan themselves money from their own company. Okay, Sarbanes-Oxley establishes general rather than specific requirements. This is just a slide noting the way the law is structured. The government can't police everything. Good law is written in a general way and not in a specific way. Okay, what the law should do ideally is it needs to be written specific enough to target bad behaviors, but not so specific that it is too myopic or too detailed to be able to encompass a broad variety of different behaviors. It's then up to the court system, ideally, to interpret the law so as to ensure that that general application, law of general application, applies correctly in this particular place. Management must determine for themselves, as a result, the structure, approach, and level of documentation and formalization that gives the CEO and CFO the requisite basis and confidence to provide Section 302 quarterly certifications. Okay, so Sarbanes-Oxley, as I mentioned before, the idea is to try to enlist management on the side of the government to ensure that the structure internally of the company is conforming to expectations of honesty and open reporting, transparency, and so forth. But the actual nature of that is left up to management. Okay. The law stipulates that for instance, that the SEC expects each company to develop a process that is consistent with its own business and internal management and supervisory practices. Okay, let's pause for breath. Questions or comments about part 2? Everybody still awake? Okay. I have a quick question for you guys. This will just take a minute. So laws like this are sometimes controversial. Generally speaking, people who think that the role of government in business can be used for good advocate laws like this and say the job of the government is to impose adequate regulatory requirements, et cetera, et cetera. Okay, and those people, not always, but generally tend to be more towards the left of the spectrum when it comes to these kinds of issues. People further towards the right of the spectrum find these kinds of laws onerous and difficult to comply with. I mentioned how expensive this sort of a law is. Often it leads to inefficiencies in the way businesses are constructed. On balance, is it better to have these kinds of laws than not to? Is some sort of law needed? Is a law this extensive needed? I don't know. One or two people? Anybody? Yeah, Brinkley?
Like, it's too extensive, like, I mean, I think the law, I mean, like you said, it's 35,000 pages, like, what is on there that,
Right.
I mean, I understand, like, the need for laws like that, like, you can't just go around having lawlessness, because that puts a ton of people at a disadvantage.
Mm-hmm.
Obviously, there's a fraud and everything else, but, I mean, like,
This is a lot of
yeah,
a lot of
it's
regulatory
It's
legislation.
really expensive, like, how can you expect, like, companies with, like, less cash flow to compete with?
Sure. Yeah, and in fact, one criticism of Sarbanes-Oxley is that it implicitly heavily favors the established companies over and against smaller competitors because the costliness of the law and compliance with the law serves as like a barrier to smaller competitors to be able to expand their operations. So yeah, that is a common criticism. Anybody else? Is the extensive regulation worth it?
Maybe
To an
to like an extent.
extent?
I agree with like Brinkley, like just because like you said, the cash flow for like smaller companies that aren't as like big, like how do you expect? I mean, obviously you want your company to be like doing well and reporting correctly, but like you said, 35,000.
Yeah, it's a lot of regulation.
Yeah, it's just a lot.
Often what happens in practice is there will be a big scandal and the government will come in afterwards and will pass like a law pertaining to that scandal. So the government's laws are backward looking. They want to like stop what just happened from happening again. And so like they'll heavily over-regulate as kind of an overreaction against the big scandal. And then time will pass and some of those over-regulations will be rolled back because they're inefficient, they're expensive to comply with. It leads to businesses grumbling and griping about it being hard to run a business under all these laws and so forth. So they roll them back, and then there'll be another big scandal, right? And so the government will then like regulate heavily again, like they tighten it up and over-regulate, and then the process repeats itself.
So they're like just wait for like a big thing to happen. Like, oh, okay, we're like.
Well, so generally these kinds of laws this extensive only get passed when there's like huge public outcry. The public is like, we don't want Enron to happen again. Like we support heavy federal regulation. And the mood of the public will be towards regulation for a couple of years and a law like this will get passed. And then the expenses of the law get passed on to customers and it becomes very expensive to run a business and the customers pay higher prices and there are all these wings of the company that are devoted to the lawyers who have to comply with all this and stuff like that. And so things will get rolled back a little bit and head in the other direction until one or two really badly behaved businesses will find loopholes amid the rolled back legal structure, and the government will over-regulate again, is the way it will often happen.
It's just like never-ending cycle or something.
It's kind of a cyclical process. I personally do think some regulation is necessary for sure. But again, speaking just personally, I think this is too much. I think that it is the job of the government to ensure some degree of conformity. But I think also that, investing takes some risk, and like you should not put all your eggs in one basket, and you need, if you are a financier and investor, you need to do some due diligence and ascertain whether you can trust management at this particular company. And, if management does, if there is fraud or management acts poorly, then, you didn't put all your eggs in one basket or something like that. And so I think to a certain extent it's up to investors to protect themselves. So I find this extensive level of government regulation a bit too much. But it is the law, and it's important to know the law. And without a doubt, this kind of stuff does do good. There is good that comes about through this heavy regulation. Namely, it's really hard for companies to start, doing the massive fraud on the scale that Enron did and so forth. Okay, let's talk about part 3. Securities fraud conviction now can result in fines, penalties, and up to 10 years of incarceration. Prior to Sarbanes-Oxley, these numbers were lower. So white-collar crime is more heavily penalized in the aftermath of Sarbanes-Oxley than it was previously. This is an interesting, let me camp on this for just a second. This is a really interesting topic because it's really controversial. White-collar crime is generally much less punished than other kinds of crime in this country. So, for instance, you could hold up a gas station for $300, and if it's armed robbery and it's a second offense, you could get sent away for a long time. But you could also defraud investors of billions of dollars and get sent away for only about 6 months or something like that. It really does sometimes work that way. Okay, so this is a controversial thing in this country because a lot of people would say that the legal structure is actually biased towards, in favor of defendants in white-collar crime cases and against other kinds of criminal defendants. Okay, but that's for another day. Okay, maximum penalties for mail and wire fraud have been increased by Sarbanes-Oxley from 5 to 10 years. And the SEC has now been given by the law the authority to seek court seizure of all extraordinary payments made to executives, directors, partners, and controlling persons. In the last days of Enron, the executives were just giving themselves special extraordinary payments, which they were then trying to hide offshore in various offshore accounts. And Sarbanes-Oxley gives the government the power to claw that back. Okay, moving on. Another smaller part of Sarbanes-Oxley is Part 4. Okay, these are requirements affecting boards of directors and board committees. Sarbanes-Oxley does specify audit committee oversight, as well as stipulating the composition of the audit committees, reporting mechanisms, and pre-approvals. Okay, so remember, the idea is for auditors to report now to independent audit committees rather than to management. Sarbanes-Oxley gives company audit committees an enhanced role in corporate governance. Moreover, audit committees now have to approve all services provided by the accounting firm, so that approval process does not go through management, it goes through audit committees. And there have to be regular communications between auditors and audit committees, so they'll now look at an email chain and make sure that there was regular communication going on. Okay, Sarbanes-Oxley prioritizes auditor independence, that's something I've talked about already. Audit committee members are not supposed to receive compensation other than for their board or committee service, so they can't be paid under the table in other ways. Audit committee members' time is limited to 2 years. They can't be company employees or family members. So they can't be, again, too chummy with management in a way that would influence their interests and their perspectives on things. There are also audit committee reporting mechanisms that are stipulated by the law, including especially complaint procedures. Audit committees have to establish procedures for the receipt, retention, and treatment of complaints regarding all accounting, internal accounting controls, and auditing issues. Okay, so this comes out of the retaliation culture that exists in some parts of business. If you complain or if you blow the whistle on fraud that's taking place in your department, sometimes businesses will retaliate against employees that do that. Because after all, it's bad press for the business to have some sort of public awareness that fraud has been going on in the company. I mean, it's really bad press. So they'll often try to prevent that from becoming public by retaliating against people who might complain or go public with their knowledge. Okay, we are almost done, folks. We are almost done, almost there. I'm not going to go through part 6 through 9 of Sarbanes-Oxley. I'm just going to go through part 5. That's all we're going to have on the exam. There are also requirements affecting outside auditors, such as new auditor independence requirements. And additionally, all registered public accounting firms are prohibited by Sarbanes-Oxley from providing various non-audit services to audit clients. Okay, again, remember, Arthur Andersen was providing consulting services in addition to auditing services. Now they can't provide non-audit services to the audit clients. So they can't provide bookkeeping services. They can't do financial information systems design, no appraisal or valuation services, no actuarial services. You guys all know what an actuary is? Everybody know what an actuary is? An actuary is a statistician who tries to determine what the most efficient way is to do a particular policy. Often they work for insurance companies, and they'll try to outguess you on what your chance of death is. And they're actually really good. They can outguess almost anybody using statistics about what the likelihood of death is for you within the next year or 5 years. And so they decide whether the company's going to give you an insurance policy or not on this basis. They're actually really important for the ability of insurance companies to turn a profit. This is a very lucrative profession, by the way, if you're an accountant looking for that sort of thing. Okay, they can't provide internal audit outsourcing services, et cetera, et cetera. So there are a variety of different services that they can't provide. I like this one here. Any other service determined to be impermissible by the Public Company Accounting Oversight Board. So anyone that we missed is also impermissible. Okay, last slide. So requirements affecting outside auditors. There has to be mandatory auditor rotation. Auditing partners cannot be the lead or review partners for more than 5 consecutive years. Okay, so again, these auditors have to cycle out. You got to cycle out on a regular basis so that they don't become a part of the corporate family and see themselves as aligned with the interests of management. Moreover, outside auditors have to report to audit committees all critical accounting policies and practices to be used in their financial reports, as well as all non-GAAP information reports that have been discussed with management. Okay, questions? Questions or comments? Again, just to summarize about the exam, a good deal of this exam will be Sarbanes-Oxley. Okay, but it will be accessible if you just go to the PowerPoints and like know where stuff is in the PowerPoint slides. You should do fine because a lot of it will just be verbatim references to particular PowerPoint slides. So just cycle through those PowerPoint slides and you should be fine in taking the exam. Okay, I've got like 2 minutes left. I want to direct your attention to one case real fast. This is on page 99 in our text. The big scandal that brought Sarbanes-Oxley about was the Enron scandal, but there was a secondary scandal that year which was also important, and it was the Worldcom Scandal. Okay, and this was a scandal where the CEO, Bernie Ebbers, who actually died, I think, this last year, he was released from prison on humanitarian grounds because he was in very poor health and died within a month or two of his release. Bernie Ebbers was running other businesses on the side and was using Worldcom as a cash cow to fund his other businesses. So he's helping himself to company funds for the sake of keeping his other businesses afloat. Okay, and this is the other case that brought Sarbanes-Oxley about. And the hero in this case is Cynthia Cooper. Okay, at the bottom of page 99, the text says, Cynthia Cooper began to be concerned about suspicious financial transactions in accounting. So she was the vice president of internal auditing. The concern started when a senior line manager complained to her that her boss, the CFO of the company, Scott Sullivan, had usurped a $400 million reserve account that he had set aside as a hedge against anticipated revenue losses. Okay, she decided to talk about the issue with the CFO, but this turned out to place her in direct conflict with him as well as with the company's auditor, okay, which was the same auditing firm that audited Enron. However, Cooper did not give up. She decided to keep on investigating in secret, often late at night. She accessed the company's computerized accounting information systems and obtained evidence that fraud was being committed. When the CFO, Sullivan, found out about her investigation, he asked Cooper to delay her work until the third quarter, probably so he could squirrel his stock options away in the Caymans. She decided otherwise, and in 2002 informed the Audit Committee that the company had covered up $3.8 billion in losses through suspect accounting practices. When these facts became known, Worldcom shares fell 76% in after-hours trading. Thousands of jobs were lost. It was a very sad incident that, again, probably occurred because maybe the regulatory environment at the time was a bit under-regulated. If we're over-regulated now, we're a bit under-regulated then. This case is instructive, I think, because Cynthia Cooper is a hero, just like Sharon Watkins. She went public with her knowledge at a time when she could have faced very real retaliation. It ends up well for her. She's named the Person of the Year by Time Magazine. She goes around giving talks to ethics conferences and publishes a book and stuff like that. But of course, she didn't know about that when all this was taking place. Okay, there may be a question or two about the Worldcom case on the exam. And this is the other, besides Enron, the other background fraud case that brought the Sarbanes-Oxley legislation about. Okay? I'll let that be it for the day. Thank you for your attention.